Let's now connect with Funny Shekhar, fund manager with Angel Stockbroking. Funny, good morning. Thank you for joining us. Funny, based on this week's market action, what is the big headline? Do you think in the near term Indian markets they've hit some kind of a wall, and because global local triggers are missing, it will be difficult for markets to generate any upside momentum in the short term?
Good morning. I guess in the very near term, at least from a domestic policy front, one is fixated on whether the government is able to push through the banking amendment. Generally, any other year, last week of December, you will not have any institutional action, especially from the FIIs. But this time around, January 1st is also the deadline for the fiscal cliff. So I don't think this year the new year is going to be all that dull as far as the markets are concerned. So for the next 15 days or so, I guess the action will shift from the domestic to the international. But over the medium term, I guess the market is more or less, at least Indian market is more or less in a cynical mindset, because yesterday after one-off data that you saw, the market actually reacted in downwards because it then thought that there was no chance for RBI to cut interest rates even by 25 basis points. So going into 2013, I get a sense that the market is not pricing in any meaningful recovery in the macro. It is just pricing in 25 to 75 basis points of interest rate cuts. So, while I agree that 8% kind of data is a one-off and cannot be expected going forward, but if you have a sustainable IIP growth of anywhere between 4 to 5%, then I guess the market gets a fresh zone to recover by at least 5 to 10%. So that's a surprise, at least for the first 2 quarters of 2013.
Funny, hi, morning. You just talked about the banking bill. Which of the bank licensee contenders are you most bullish on?
We don't know what will be the final guidelines of RBI, but whatever one has been given to understand since this particular policy paper was in public domain, you can safely conclude that non-promoter led entities have a very good chance of succeeding at bank licenses. So within that space, you have an L&T Finance Holdings or a LIC Housing Finance that come prominently to your mind. But being positive on them to hold a bank license is very different from buying them, because L&T Finance Holding today commands a market cap which is much higher than equivalent or even large-sized some of the large-sized private sector banks. So buying at this price point is a strict no-no. But from a banking license point of view, I think these two names come readily to mind.
Bharti Infratel, does the company interest you, and are you bullish on the fundamentals of this one?
Well, the company is certainly interesting. Fundamentals are also improving, but I'm not too enthused with the pricing of this issue because, look, the return on net worth for this company at this point in time stands at 6.5% for this year. And while I agree with the point that the return on incremental net worth is as high as 30%, but it will take them at least 4 to 5 years to reach an acceptable threshold of 16-17%. That makes sense for any equity investor to invest in the equity markets. So in order to reach that, if it's going to take 4 to 5 years and the valuation today already corresponds to that threshold level of return on net worth, then who pays for the time value of this next 4 to 5 years? So the fundamentals, to my mind, are at least 3 to 4 years behind the pricing. So my advice to retail investors would be that they can safely give a pass to this issue, and they can easily wait, and I'm sure that they will get this stock at much more attractive valuations, either adjusted for time or adjusted for price sometime in the future.
Funny, that's a fair point, but let me throw in the other dimension, which is the global comparison here. If I look at global companies, they're trading at 15 times, some are trading at even 18 times EV to EBITDA. Bharti Infratel is only priced at about 7 times. Globally, businesses are mature. For Bharti Infratel, the growth has just started.
Yes, I agree with you. Globally, they are operating at a margin of somewhere around 70-75%, which happens at the maturity level. Bharti Infratel can still grow its margin, mainly on the basis of tenancy. Volume growth unfortunately might not come because market is already 65 to 70% penetrated, and while the points on 3G and 4G are well taken, it's just in the realm of hope, and we don't know what kind of incremental capex will be required to achieve the kind of volume growth management is projecting on the back of 3G and 4G and data. Having said that, while the EV beta multiple is fair, one also has to consider the fact that globally, since you pointed out businesses are mature, they're already generating an acceptable return on net worth. For this business to get to that threshold return on net worth, if it's going to take 3 years, which actually includes an expansion in EBITDA margin, which actually is making the EV to EBITDA multiple attractive at 7, to my mind already captures that inferior return on net worth. So I think that investors will be much better off not to pay this steep valuation of 44,000 crore at the top end of the band for a company that will at best generate 2,500 crores in net profits 3 years down the line.
What's your current portfolio strategy? Is it time now to sell the winners, take some profits off the table with the assumption that into the year end we could see some more unwinding?
Not really. We are not taking a market-based call. We are looking at a stock-specific strategy. So while buying, we continue to avoid sectors which are capital guzzlers, because we clearly believe that for the next 6 quarters or so, the environment is going to be sticky for these kind of businesses such as infrastructure and others. We continue to buy capital asset-light companies in sectors such as rural consumption, which has been our favorite theme, because we believe that over the next 4 quarters there is going to be great revival over there. We're already seeing signs of that. Banking is another sector that we like. Where we are finding that we have made enormous number of gains, amount of gains, such as in smaller PSU names within a very short period of time, and where going forward we are not too comfortable with the outlook compared to the valuations, we are seriously relooking at booking some of our gains out there. So these can be names such as an Andhra Bank or an Allahabad Bank, to name a few.
Mani, what are your thoughts on two-wheeler stocks? Are you a bit surprised with the inherent strength Bajaj Auto or Hero MotoCorp have, they both have reported? The dynamics of the two-wheeler market are changing. Most of the two-wheeler companies are maintaining that it will be difficult for them to grow, at the current run rate. What, to your mind, explains the sudden strength in both Hero MotoCorp and Bajaj Auto?
I guess Hero MotoCorp is more of a rub-off effect because of the rally in Bajaj Auto. Two-wheeler market is reaching a very interesting stage where you do not have any input price pressures any longer. So commodity prices are behaving themselves, which means that the pricing power as far as the OEMs are concerned is also limited. You are seeing very subdued volume growth, but wherever the incumbents have introduced innovative products like Discover 125 ST or 200 NS Pulsar, which was introduced by Bajaj and which was well received by the market, you are seeing that they have been wresting market share. So Bajaj Auto's market share in the executive segment has gone up from 17% all the way up to 24% in a span of about 8 months, which is no mean feat. Another reason why Bajaj Auto has been very strong over the last 2 months is 40,000 new three-wheeler permits being released by Delhi government. Three-wheeler, as we know, is a 30% operating margin business for Bajaj Auto, and it's a market leader out there. I think so a combination of these factors is helping Bajaj Auto. But I'm not so sanguine on Hero Moto because, as I said, it's more of a rub-off effect, and that's clearly seen because the discount has considerably narrowed between Bajaj Auto and Hero. And I believe that going forward, the best of the times have just begun for Bajaj Auto, because on the back of even a subdued sales growth, you can expect a 20% plus kind of an earnings growth. Also because the export market has considerably improved. From a 14,000 unit per month run rate, they have improved to 24,000 units a month run rate. So FY14, Bajaj Auto might report more than 20% plus kind of earnings growth. So you can expect easily a 20 to 25% upside even from these levels in Bajaj Auto.